So hello everyone, welcome back to my channel. So this video will be all about introductory macroeconomics for semester 2, where we will be discussing some important concepts and along with important numericals that have high chances of coming in the final examination. And you can all find my complete notes for introductory macroeconomics in the description of the video. But before accessing that, we must see how the syllabus goes around and what can be gain from this session. So let's begin. So we basically have 4 units, starting with national income, money, income determination, and then the most important topic, that is ISLM model. So let's begin and with the syllabus. So first, in national income, we have the GDP, which is a very simple concept, as you can say it to be final value of all final goods and services produced in the country in a year. Mind the handwriting, it's a bit dirty. Now moving to expenditure method, you can see from my notes here that in expenditure method we have got GDP at market price equals C plus I plus G plus NX, which are basically consumption, investment, government expenditure, and net exports. In consumption, the division goes like this, that we have non-durables, durables, and services. In investment, we have gross business fixed investment, residential investment, and inventory investment. Now these are some important formulas of which you have to make track of, because this can come as to simply calculate as one of a part in income determination questions, which are basically the private disposable income, which is Y minus taxes minus interest on public debt minus transfers plus net factor product. Now from debt, government income, the taxes which the government earns during the year, the transfers it pays, and minus the interest payment it makes on the debt. Also, private saving would be Y minus taxes minus interest minus transfer plus the net factor product and minus the consumption, and this is basically the income, whole income for private sectors, and this is the consumption, so that we get the private savings. Similarly, the government savings, the government's revenue minus its expenditure. And now national saving would be private savings plus public savings, and we have got the Y plus net factor product minus C and minus G. Now moving forward, we have the nominal GDP. We can calculate it at prices of year 1 into quantity of year 1. Okay. Now suppose we have to calculate the real GDP. Now we will be taking the prices of the base year but quantity of the year in which we are supposed to calculate the real GDP. So it would go like this: prices at base year into quantity of current year. These are simple basic concepts, but these can be asked in several parts of the question. Now for GDP deflator, we all know that it equals nominal GDP upon real GDP into 100. Okay, so now let's move to the BOP part. Now there is slight addition to the BOP we learned in class 12. We always had the current account and capital account, but this time we also have the financial account, the details about which they are in my notes. You can also refer to that. In current account, as usual, we have on debit side we have the import of goods. It leads to outflow of foreign exchange, import of services, unilateral transfers to abroad. In credit side, we have export of goods, export of services, unilateral receipts, and these all include the inflow of foreign exchange or foreign currency. Okay. Now moving to capital account. Here we have the assets and liabilities part, capital expenditure on the debit side, capital receipts on the credit side. Any transaction which leads to increase in asset of the country, resident country, leads to debit side, and any decrease in liability of the resident country leads to debit side. Similarly, the reverse works in credit account. Now you can find all my full notes in description, and make sure to subscribe if you love the notes and there would be many videos coming for all the examinations on semester 2 in e-commerce. Okay, so now a topic which is money. You can find the important notes in my notes PDF in the description of the box. So I'm basically skipping that, but you can always read the readings and try to solve the back questions. Now it is not that important, but you have got to know the basic concepts of the balance sheet of the central bank and related concepts. Now we will straight away move to income determination and the ISLM model, which are basically a club topic, and huge weightage there is for for these topics in semester 2 exam. Okay, so now we had a two-sector model in which we have the household sector and the business sector. Basically, we only have in two-sector model as consumption and investment. Okay, now in three-sector model, we include household as usual plus business sector. And we also include the government, as government also makes many expenditures throughout the year for the country's development and for taking debts and all. It collects taxes, and also it provides transfers in the form of subsidies and all. So we include them in the form of C plus I plus G. These are some basic ones. We will be straight away move to numericals, which are very important for SEM-2 perspective. Now moving to the four-sector model, in which we include the foreign sector as well. Now we will always have the household sector, business sector, government sector, and the rest of the world, as we say, foreign sector. Now to include them, we write in the manner of just a second. We can simply write them as C plus I plus G plus exports minus imports, or C plus I plus G plus NX. Okay, so now before moving to the numericals, we should see some basic concepts. So let's move to my notes and get hang of some important things. Okay, so these are my notes. You can find them in the description. And now we are going to see some basic things and then straight away move to the numericals. Okay, so we have the two-sector model, as I have already explained. We have household sector like this, in which there is consumption meta household sector, and we have C bar plus small c into y. Now this C bar autonomous, small c is the MPC. These are some basic things. You can see the diagrams here. We have the business sector, which makes investment expenditure, which we are assuming to be autonomous and given as I bar. Now moving to the equilibrium condition, we have the aggregate output should be equals to aggregate expenditure under two-sector economy. We have y equals c, this is c plus I, which is given as I bar. Now clubbing C bar and I bar into autonomous expenditure and writing it as A bar, we come along that y equals A bar upon 1 minus C. Okay. Now we have some concepts like planned inventory and unplanned inventory. Like when unplanned investment is positive, then output is greater than aggregate expenditure. Now firms do not have much demand for their output, so they decrease production. In subsequent time period, the employment falls and factor income reduces, which leads to a fall in income. And vice versa works in unplanned inventory disinvestment. When the unplanned inventory disinvestment are negative, firms have huge demand, so to meet that excess demand, firms increase their production, employment increases, the factor incomes of the household sector increase, as a result the income also increases. Okay. Now there is an important concept known as the multiplier, which is basically defined as a change in equilibrium level of income, that is YE, due to change in any aggregate autonomous expenditure component, that is A bar. We have sometimes in two-sector model we have I bar plus and C bar as that. In three-sector model we always be having G bar also, and so on. So let's have a simple numerical about it. So we have here C, consumption is given as 100 plus 0.6y, where this 100 signifies the C bar component. We have I bar as autonomous as 500. Now we first calculate the equilibrium level of income, that comes to be y equals C plus I. We go on solving it out and we get 600 plus 0.6y equals YE. Now moving forward, we get 0.4y equals 600. Then we get YE as 1500. Okay, now in another part we get to know that our investment has changed by 200, let us suppose. Okay, we calculate the equivalent level of income Y equals C bar plus CY plus I bar. We club them C bar and I bar into aggregate component, autonomous component A bar. And then we get Y equals 1 upon 1 minus MPC into A bar. Now this 1 upon 1 minus C, small c, this is the multiplier. Okay, so for example, in this question, which we calculated Y equals 500, we get to know that investment has increased by 200. What will change in Y? So simply we will be multiplying the multiplier with the change in investment, that is 1 upon 1 minus, what was the value of multiplier in this? MPC, we have got 0.6 into the change in investment. So we will get delta Y equals 200. 1 second. We have this as 200 upon 0.4, which comes out to be 500. So this is the use of a multiplier. We can calculate the change in equilibrium level of income with the help of multiplier. So this is something important. Now moving to next concept, which we have. Now you can see here consumption expenditure. In three-sector model, we have consumption expenditure, where consumption is a function of disposable income. It is not income but disposable income. This is a very important thing because we often make mistakes and rule out the taxes component while solving for three-sector model income determination numericals, where YD equals Y minus taxes taken by the government plus transfers given by the government. Now taxes can also be lump sum, which is autonomous nature, where simply as T bar they would be given, and also induced nature, where they would be proportional to our income, basically the proportionate taxes. Now we have consumption expenditure by household sector, where that would be C bar plus C and multiplied by YD, which is the disposable income. Now moving ahead, we have the business sector. Again the investment is autonomous. Government sector, government expenditure again given as autonomous. Now here you can see the multiplier things. Here the multiplier turns into alpha G equals 1 upon 1 minus C into 1 minus T, because of the introduction of taxes and three-sector model with the government. Okay, now this simple thing, they are budget surplus, which is basically the receipts of the government minus expenditure of the government. Receipts are in the form of taxes and expenditures in the form of government expenditure and transfers. You can have a basic idea of the concepts from my notes. Okay, now moving ahead, we have the balanced budget multiplier. Now basically what is the balanced budget multiplier says that when the government increases expenditure by some amount, it recovers that amount in the form of offsetting taxes. Like changing government expenditure would be equal to the changing taxes. Now taking this equation into account, we solve for the income determination through this question. We can see the consumption function is given, investment function is given, transfers are given, government expenditure is given. We go on solving this like in the usual manner. Now if we are given that delta G bar equals 100, then by balanced budget multiplier definition we also have that delta T bar would also be equal to 100. Now we solve this and we'll be getting delta Y by delta G equals 1. Now we have basic definition for the BBM, that is balanced budget multiplier: change in equilibrium level of income due to increase in G bar, where entire change in government expenditure financed by imposing equal amount of tax. Like I said earlier, delta G bar equals delta T bar. Okay. Now we have this investment function, equally important. Like the investment function would be around from the Keynes category. We would getting I equals I bar minus BI, where B signifies the responsiveness of investment to a change in the interest rate. Okay, interest rate for investment purposes for borrowing loans by the corporates or the business houses. We have plotted the investment function here, and we have shown the movement and the shift alongside. Now we will move towards the ISLM model, which is the most important thing from exam perspective. So let's begin with the ISLM model. Okay, so basically what ISLM model says is that there are two good markets, which are the goods market and the money market. In both of these markets, we have interest rate and income, which are uniquely determined by the demand and supply forces. Now what are these? Let's begin understanding them. So now basically what we did in income determination is that we put y equals aggregate expenditure, where we have C plus I plus G. We go on solving them. We get y equals A bar minus BI. We are taking investment function as I bar minus BI, which we explained earlier. And consumption is a function of disposable income, which is y into 1 minus T. And we go on solving and we get y equals alpha G whole into A bar minus BI. This equation pertains to IS model, IS curve basically. Okay. Now for derivation of IS curve, we'll move to our notebook and see how this moves out. So basically the IS curve shows different combinations of income and output where goods market is in equilibrium. Okay, so let's see how this works out and how do we derive this in IY space. Okay, so now deriving the IS curve, we first take three panels in which we have interest rate and investment. We have I and Y space, where we're going to derive the IS curve, and we have the aggregate expenditure and Y space. This is the 45 degree line along which we would be having Y equals A. Okay, now draw a downward sloping investment curve, that would be I equals I bar minus B I1. We take this as I1, sorry, this as I1, level of interest rate. This is also I1, and we take the first aggregate expenditure curve to be like this, E1, or Y equals A bar minus BI1. So sorry, it would be alpha G into A bar minus BI1. Okay, so for deriving the IS curve, we take the I space, interest rate investment, IY space, in which IS curve is, will be derived, and aggregate expenditure in Y space. We take the first level of interest rate I1 at some arbitrary value, and in downward sloping investment curve, we have first the I1 level of interest rate, which would be this one, and taking the I1 space also. Now now we will be having the intercept here, A bar minus BI1, for Y equals C plus I, a function of I1, no bar here, okay, plus G. So now we have first level of interest rate, initial interest rate, at which the investment curve is this I bar minus BI, okay, taking that interest rate into the IY space, and also marking this level of output, taking this one as given, we have Y1, and this point we have with Y1. Okay, now suppose we take interest rate to fall, interest rate falls from I1 to I2. Here you can see the fall. Now since this is a change in the given variable on the axis, there would be movement on the investment curve, which would take this point in the investment curve. We take this interest rate as I2 in the IY space, move across it, and we don't know the y yet for I2. Okay, now we have to use some economic theory here. Since interest rate has fallen, now investment as negative function of interest rate will increase, our income would increase, as a result aggregate expenditure increases. Now interest rate has fallen, but in this AE and Y space we don't have interest rate as an explicit variable, so our aggregate expenditure function would shift out parallelly. and this would be intercept would be a bar minus bi2. Now from here we will getting the new output level, the fall in interest rate, and we will take the intersection of it with I2, and we have derived 2 points, and we will be labeling them, joining them, and getting the IS curve. Okay, so this is the derivation of IS curve. Now this is the equation given for IS curve. We have written it. Now we have got to get the slope. Since this is IY space, for slope we need di by dy. We differentiate it, and we will be getting minus 1 upon alpha g into b. This expression is the slope of IS curve. Now there are some factors affecting the slope of IS curve, which we get as b, responsiveness of investment to change in interest rate, and alpha g. You can see it. Some good explanation is there with the help of diagrams. Now this is not so much important like b and alpha g, but slope of IS curve we should know how to calculate it. Now we'll be getting the shift in IS curve as government expenditure increases, autonomous component increases like this, and the magnitude of the shift in the IS curve would be alpha g into delta a bar. Okay. Now we will be straight away moving to the money market to derive the LM curve. So let's begin with the LM curve now. Now the LM curve gives us different combinations of I and Y, again interest rate and output. Okay, so LM curve show different combinations of interest rate and income at which money market is in equilibrium. Now for money market to be in equilibrium, we need money demand and money supply. Okay, now our money demand, the equation for money demand is KY minus HI. Okay, for money supply we have M upon P bar. We take price level as given and we write it at as M upon P bar. Okay, so for money market to be in equilibrium, we need money demand and money supply, which are as follows. We have money demand as KY minus HI, where this is transaction demand for money, this is speculative demand for money, for bonds, stocks, etc. And we have the money supply given as M upon P bar. We take price level as constant, and this is the real money supply. This is the nominal money stock, and this whole M upon P bar is the real money supply. Now we have money market equilibrium as MS equals MD. We write both the equations, and we have the I space, interest rate space, and demand supply of real money balances. And the money supply as given as usual, M upon P bar. And we have downward sloping money demand function, KY minus HI. And we have the equilibrium at E1, where I1 is the equilibrium interest rate, and L1 is the equilibrium demand for real money balances. Now we'll be straight away moving to derivation of LM curve. Okay, so now deriving for the LM curve, we take the interest rate space and demand and supply of real money balances. We have the money supply as given, M upon P bar. We have the demand for money downward sloping, KY1 minus HI1. This we have the initial equilibrium. We take this into the IOY space and take this the initial level of output. Okay, so we have this 1 point for I1 interest rate and Y1 output. Now suppose we increase the income. With increase in income, we have increase in transaction demand for money. As a result, the demand for money function shifts rightward. We have an increase in interest rate from I1 to I2. We take this interest rate into the IY space. We have a new income level Y2. Okay, now we have got this point also. We join this and we get the LM curve as follows. Now for the equational form, we have LM curve as money supply, real money supply equals demand for money, KY minus HI. Okay, now some basic things like the slope of LM curve and the other shift in LM curve or factors affecting the slope of LM curve are given in my notes. You can have a quick read at them. And now we will be moving to the numericals straight away. So let's begin with the very first question. We are given with the consumption function, investment function, G bar and T. So first of all, let's calculate the equilibrium level of income, which we can find out by keeping y equals C plus I plus G. Plugging in the values, we get 20 plus 0.8, yd equals y minus t. We take it. Now we plug in the values straight away. 50 plus 20. Okay. Now we get 0.2y. Yes, 0.2y equals 20 minus 0.8 into 10 would be minus 8 plus 70. We get 0.2y equals 90, 82, and we get ye equals 82 into 10 by 2, 410. Now we need to find out consumption and savings at equilibrium level of income. We get consumption as 20 plus 0.8 yd is y minus t. We have 410 minus 10. We get it 20 plus 0.8 into 400. We get this as 340. Next, for savings, now savings would be disposable level of income minus our consumption. We have yd as 400 minus 340 equals 60. So this we have solved. Okay, so now suppose we have change in government spending as reduction of minus 10 units, reduction of 10 units. So we will what will the change in the equilibrium level of income? We will use the multiply concept, as we know that delta y equals 1 minus c. Now we are not taking this 1 minus t since we have lump sum taxes, so t equals 0 here, and there we have delta g. Okay, so delta y we would be having, just a second, delta y will be having 1 upon 1 minus 0.8 into delta g, that is minus 10. We would get minus 10 upon 0.2, which comes out to be minus 50. So our new equilibrium level of income after reduction government spending of 10 units would equal to be 410 minus 50 equals 360.